Good afternoon, everyone, and thank you very much for coming and for joining us. My name is John Flesher. I'm the Head of International Programmes at the Conservative Environment Network, which is the home for Conservatives who care about decarbonisation and conservation. This is the 15th of SEN's 18 conference events in Manchester this week. Please do have a look at the blue leaflets on your chairs, which detail our remaining events. And do please follow our website, which is cen.uk.com, and our Twitter, which is @CEN_HQ, using the hashtag CEN@CPC, if you can get your head around all those acronyms. This event today is all about financial services, what opportunities exist for the services sector as we strive to reach net zero emissions. So much of the debate on our response to climate change is dominated by things like wind turbines, electric vehicles, tree planting, the physical things that we manufacture, that we construct and that we grow. And contrary to that, our economy is so heavily reliant on services that it's a very unspoken, or at least muted, part of the debate often in politics, and we hope to begin to change some of that today by exploring the huge potential that financial services and the services in the sector in general can play in driving net zero and in exploiting the opportunities that Going Green presents. I would like to pay a special thanks to our sponsors, Aon, who've made this event possible, for their interest and their generosity, so thank you very much. And I'm joined by another stellar SEN panel, so joined by MPs Felicity Buchan and Gareth Davies, and joined also by Joanna Sharples from our sponsors Aon. We're hoping to be joined by Howarth from ShareAction, who is a work in progress, I think we'll say for now, but I'm hoping she'll be able to join us later on. We'll get started with some short opening remarks from each of the panellists, followed by some questions from me and from you in the audience. So I'll begin by asking Felicity Buchan, the Member of Parliament for Kensington, PPS at the Department for Business, Energy and Industrial Strategy, Trade Envoy to Iceland and Norway. I sort of want to say, Mother of Dragons at the end of it and add another one. But Felicity, yes. Over to you. Thank you.
Well, thank you. And it's a real privilege to be here. And I want to start by thanking SEN for all the work that they do within the Conservative Party to promote the green agenda. And I think it is very, very important that we as Conservatives make the case for environmentalism and tackling climate change. This is not an issue which should be led by the Green Party or by the left. This is an issue which needs to be owned by us. And I would also like to thank our sponsors, Aon. Green finance, in my mind, is a huge opportunity for the City of London. We clearly have gone through a period of a couple of years where we have seen some financial services jobs relocate to Europe. Now, not to the extent that many of the doomsayers had said, but clearly jobs have moved in clearing and in share trading. I see green finance as being a huge opportunity to make up that gap and indeed to really prosper in the City of London. I also see fintech as another huge opportunity. Now, if we talk about green finance, I see it meaning two things. First of all, it is financing green projects. And we clearly had the very successful green gilt a few weeks ago that my colleague Gareth really lobbied very, very hard for. And that will go towards financing green projects such as wind power, low emission buses, decarbonising homes. But there's another strand. It's not only financing green, it is also greening finance. And what do I mean by that? I mean that the City of London needs to put environmental measures at the heart of everything that they do. And this is not simply for philosophical reasons. This is because it is also the economically right thing to do. There is no question that there is an awful lot of money going into green investment products. If you look at the green gilt, it was 10 times oversubscribed, a 10 billion gilt, and also it was priced a couple of basis points through the existing government curve. Now, I'm an ex-banker, so I'm talking slightly in financial markets terminology, but that means that it achieved slightly cheaper financing for the UK government than a regular gilt. So it is economically efficient. There's no question in my mind that there is going to be more and more money going into green finance. And I personally am very excited to look forward to what NS&I is going to be doing with retail green savings, because certainly talking to constituents on the doorstep, every single person brings up environmental matters. So if you can actually take your, whether it's your £20 or your £2,000 and put it into a green NS&I investment vehicle, I think that that is very, very powerful. I think government is doing a very good job in setting the framework. We are ahead of the market in terms of climate risk disclosures, making those mandatory by 2025. We have committed to implementing a green taxonomy. And again, that is a technical word, but that simply means a framework for identifying which investments are green, because we don't want to be in a position where these funds say they are investing in green instruments, but don't actually do so. And a few of you are nodding in the audience. You may have seen that there was a whistleblower from BlackRock who said that a lot of these green funds, they're charging higher fees, they're promising better returns, and at the same time, they're saying that they're going to improve the whole of society. And is that actually possible? And we do need to be very practical and very pragmatic. I don't think it's necessarily possible to offer better returns and achieve the transition. So we need to be very, very open in terms of what is possible. But in conclusion, I think this is a huge opportunity, not only for the City of London, but for financial services throughout the UK.
Oh, brilliant. Thank you very much, Felicity, for those very helpful opening remarks. I think particularly setting up that split between greening finance and financing green, as you put it like that. So thank you. I'm going to turn next to Gareth Davies, the Member of Parliament for Grantham and Stamford, who sits on the Finance Select Committee and is Vice Chair of the APPG on Sustainable Finance. Also, like Felicity, a very valued member of the SEN Parliamentary Caucus. Gareth, over to you.
Well, thank you very much. I'm never going to follow Felicity ever again, because she had so many good points in there that I was going to make. Let me just fiercely agree with the vast majority of what she said. I think the context to all of this is that there has been a shift in our country, in politics, in finance now, that we are facing the facts and that climate change is a reality that we have to act on. And one of the bugbears, perhaps, since entering Parliament in 2019 is that a lot of the debate is about what the government's going to do about this, but not enough about what the investment industry can do about this. And we have, for example, the second largest pension fund market in the world, £2.3 trillion, that we really haven't utilised to the extent that we really could have or should have over many years now. The good news is that ESG funds are growing quite significantly. My time in the city, I was 14 years in asset management, last few years running a global ESG business. The number of funds that exist in the world, but especially in this country, really has gone off the charts, and that's been driven by demand from individual savers, pension funds, and other institutional investors around the world. And I think one of the reasons that has happened is because there's been this shift, and it's no longer just about morality and about a view on whether climate change is a good thing or a bad thing or whatever, in terms of my own values and the planet I want to leave behind. It's become part of a risk management framework for investors. It's become part of the investment process, which says that if you do not factor in environmental considerations into the companies you're investing in, you're going to suffer financially in terms of your portfolio's performance. And we showed this time and time again at my old shop. One of the things that's helped with that is the quantification of ESG factors and the transparency among companies that are in particular listed. And so that's been a huge development for the industry, which has enabled green finance really to be very prominent now in the industry. The other aspect, as Felicity pointed out, was the growth in green bonds, so hypothecated, dedicated green debt. We saw the UK government issue 10 billion tranche, as Felicity said. It was oversubscribed in the first hour, 90 billion pounds worth of demand. So it just shows that the demand is out there. We're going to get another tranche later this year, and I think we'll keep going with that because it saves the exchequer money compared to the non-green debt that we're issuing, but it also helps ring-fence capital for investments in renewable energy and the things that Felicity was talking about. So I think the government are actually doing a significant amount. I could talk about TCFD as well, which is around disclosures, and again, saying that light is the best disinfectant and making sure that people know where their money is going. Very interesting statistic in terms of the pension funds. Only about 22%, according to the PLSA, of people who have a pension actually know where their money is invested. So I think anything we can do to increase transparency as to where your money is invested, I think will only increase the pressure on investment managers and pension funds to offer more options and to invest again in a more sustainable way. There are three things I think we need to do, though, in terms of progress. First of all, I would like to see investors, and particularly, again, I'm afraid, pension funds, be able to take on greater risk. And by this, I mean investing in illiquid assets, so those that are not daily liquid, daily tradable. So things like renewable infrastructure projects, renewable focused transportation projects, things like that, I think would be hugely helpful, not just to our net zero ambitions, but to pension funds to be able to reflect the values and views of their trustees, but also, again, to enhance returns. Secondly, as I pointed out, transparency is a big factor for me. And thirdly, as Felicity was saying, I think fintech will help a tremendous amount to enabling more younger people to access investments and savings products and to be able to see where their money is going. I'll leave it there. Thank you.
Thank you, Gareth, very much for another very comprehensive overview, and I think a very positive statement about the amount of value that actually can be driven by financial services. I'll turn now to Joe Sharples, who is a partner in Aon's investment practice and the Chief Investment Officer for Aon's DC Solutions. Joe, thank you very much for joining us, and some opening remarks from you.
Thank you. Thank you. Hopefully that's better. Make it a bit lower. I've spent 20 years in the pensions industry, so I'm kind of here today to give you a bit of an insight from an investor perspective and particularly from a pension scheme perspective. But I wanted to start with talking a little bit about some of the trends we've seen over the last few years in terms of demand. And I think the great news is, and this echoes comments that Gareth has made, is that there is a growing awareness and appreciation among pension scheme investors, so the trustees who are looking after that money, of the importance of these issues and how it should be factored into their investment strategy. We run a biannual responsible investment survey which goes out to UK investors but also around the world, asking for institutional investors' views on responsible investing and sort of what they think about it in the future. And the findings of that have been really interesting, tracking progress. And what we've seen in our last survey, which is just about to be released, is a really big step change in attitudes over the last two to 4 years in terms of, particularly I'm speaking about UK pension schemes here, but in terms of how they're thinking about it. And it's over 95% saying that responsible investment is important, very important, or absolutely critical. And that's a big shift from when we asked the same question 2 years ago. And also, in a similar theme, when we asked investors what are the top things that are worrying them, over 60% point to climate change as being the overriding factor. And obviously there's a lot more than that, but it's interesting to see that's coming out. Now, one of the things that's connected with that, and it probably doesn't come as a surprise, is that pension schemes are starting to shift their investments away from sort of more traditional funds and investing in investments that have more of an ESG focus or a responsible investing focus. And we've seen that starting to happen, and certainly a lot of the work that I'm doing and the decisions that I'm making on behalf of our members it's all about that at the moment. I think what's encouraging looking ahead is that schemes are continuing to do that. So we've got pension schemes who haven't done anything, and actually they're telling us, yes, they do want to do something. But I think the pension industry, it's a little bit like an oil tanker. It takes a little bit of time to get going, but having seen this, I do feel, and it's quite exciting having worked in it for so long, but it's at a bit of a tipping point, and it's got the momentum, and it will keep going. The other thing to touch on is perhaps around net zero targets, and this is quite a challenging thing as an investor, thinking about how do I actually green my investments? How do I make them net zero? I'm not sure anyone has got all the answers, but we're seeing pension schemes making commitments. So it's around about 25% of schemes have made some sort of commitment. There's about another 40 to 50% who want to make a commitment. And again, I think that's a big shift. If we'd asked the question a couple of years ago, we'd have probably got a very different answer. It's also very, very different when we look at UK investors versus, say, US investors. And actually we see that the UK market has shifted quite a long way ahead of our sort of US pension counterparts. And I suspect in terms of why that's happened, I think some of it's down to increased regulatory focus and all the things that pension schemes have to do. I think a lot of that's been hugely positive. But also, as Gareth said, it is trustees actually thinking, yes, this is a big risk. It's something that needs to be managed like I would do with other risks. And again, that's fueling the demand for sort of pension products. Now, in terms of the opportunities for pension schemes, I thought it was just worth touching on some of the differences that we see in terms of types of schemes. So hopefully this isn't too much of jargon, but we have defined benefit schemes, more akin to what we have in the public sector, but effectively this is a contractual promise. The company pays the cost for it. Now, a lot of these defined benefit schemes they have moved along, they're quite mature now, and actually a lot of them are looking to secure those pensions with an insurance company. So for them, in terms of their risk appetite, it tends to be at the lower end. So I'm intrigued about you saying you want schemes to take on more risk. For some of those schemes, they might not be in the right place in their journey to do that. But equally, as they pass those promises across to an insurance company, it may well fall to the insurance company to do something like that. On the other side of the scale, we then got defined contribution schemes. So these are where employees and companies put money in every month, you invest it, and the employee will get a pot of money at the time. That's my pension, that's what I've grown up with and come to know and love. But with that, the emphasis is very much on the individual, and that's where most of my time is spent. And when you invest, you're thinking about investing someone's money for maybe 40, 50 years. So these issues are really crucial. And so actually a lot of the sort of green opportunities sit really well with this type of investment. And I think there is demand there to do that. There are some practical hurdles to overcome, but there's certainly the appetite. But I'll pause there.
Thank you very much, Jo. And just to pick up on some of those remarks, or just a couple of questions from me before we go to the floor, I want to try and take this to a consumer level. I think you are all people who live and breathe this stuff. You understand it. It's what you're interested in. If I'm the average consumer, I'm probably much more conscious now about the need eventually to buy an electric car. Maybe I'm starting to think about replacing my boiler. I suspect that it's not so much in the average consumer's mind that I need to be thinking about my pension, I need to be thinking about my savings account, I need to be thinking about what insurance I'm using in a green mindset. So I'd be interested in some just brief remarks from all of you on how we imbue it into the consumer consciousness. So Felicity, maybe you could take that first.
Yes, I represent a central London constituency, Kensington, so it is quite a financially literate constituency, but it is remarkable how it does come up on the doorstep that people do want green savings opportunities, and in particular from young people, because I think the environment really does imbue almost everything that young people do. I think it is very much so incumbent upon the financial services industry to go out and actively promote green products to retail investors. And I do think that they will receive a good reception, certainly in my constituency, that they will. There are, however, difficult and problematic issues. It's not all plain sailing. You know, for instance, there are pressure groups looking to get asset managers to divest holdings, let's say, of oil and gas holdings. Now, you can agree or disagree with whether that's an appropriate strategy, but it clearly has got big implications. And to the extent that a responsible investor says, I'm going to sell my oil and gas holdings, clearly that holding is going to be recycled in the market, and it could well end up being held by someone who doesn't care about the environment. So you could say that you're in actually a worse position because you've moved from an environmentally active and an active shareholder to a passive shareholder who does not care about environmental matters. So there are complicated matters, but in terms of promoting green retail products, I think that is very key and will be very well received.
Brilliant, Gareth.
Yeah, I mean, I think that we've got a bigger issue with the savings culture in this country and investment literacy in this country, and that is firmly, I think, on the industry and in our sphere as well, in Parliament. We need to do a much better job of getting more people, democratising financial services essentially, so that more people can play a part in it. And I mentioned on a panel this morning that in our country, you grow up from a young age thinking my big financial aspiration, apart from getting a job, is to own a house. But it's not about how much I'm going to save or what I'm going to save for a retirement. And actually, it's pervasive in the job market. So I read a statistic that actually only something like 20% of job adverts mention the pension that you get as part of the job, and yet it's about a third of your take-home pay. It's absolutely bonkers that this is not, and it appears on your pay slip. So I think there's a bit of work that we all need to do first and foremost to democratise financial services and investments and get people thinking about savings and retirement at a much earlier age and much more forcefully. And then part of that process is around, as I mentioned, fintech, which will help, particularly with younger people, but it's not just young people who use iPhones. And in fact, I just met an 80-year-old guy who's got a more up-to-date iPhone than I do. So, I think fintech will make a big difference in terms of being able to shine a light on where your money's going and enable you to invest in a more purposeful way. And that's kind of the third point that I would make on this question, which is the whole ESG agenda. There's a debate about values versus risk. So in my opening remarks, I talked about risk management, financial performance. It doesn't actually matter what it is that we're talking about in terms of the factor. I'm talking about financial performance. In this instance, it's about environmental considerations, how regulation is going to impact a company's bottom line. But there is a values piece as well. And sometimes you just don't want your own money to be invested in certain things. We used to manage portfolios that excluded tobacco and all sorts of different things that people just disagreed with. But people need to understand that by divesting, that doesn't change the thing that you disagree with. And it'll probably cost you money in terms of returns as well. So I'd finally like to see a shift in conversation, which is not cutting out the bad, but actually engaging with companies, all companies, to move in the right direction. And that way, we'll achieve the change we want, and you won't have to suffer financial losses as a result of that.
Brilliant, thank you, Gareth. And Joe, I'll pass to you, and maybe you could touch on the divestment point as well that Felicity and Gareth both raised. So I think trying to see where we should be on that spectrum between divesting from the bad versus promoting the good.
Yeah, let me pick up on the divestment point first, because this is something that trustees will debate about, whether you divest or whether you engage. And actually, I think the points made before is that and it was something a colleague said to me, is that, of course, if you divest, you've got no say anymore. So I think there's a huge amount of benefit in actually staying invested, not divesting from these companies, but engaging. And one of the things we get from trustees is, like, I'm only a trustee of a £20 million pension scheme. Now, £20 million sounds like quite a lot, but in the context of pensions, it's a relatively small scheme. So how can my voice make a difference? But of course, when you add them all up and you think about all the millions of savers we've got in pension schemes, that's a huge number of voices. So I think that's the message we're getting across now to our clients, is actually you can make a difference by engaging. The other point about that engagement point and divesting with companies is that often you see that the board of directors, their compensation is actually linked to the share price. And so even if you divest, although their capital is being recycled, if it takes a hit to the share price, that then has a knock-on impact on their take-home pay. And actually that sort of threat of divestment from a company can again be quite a powerful tool in getting them to sit up and take notice. And we've certainly seen that in sort of conversations with clients and asset managers in terms of how that interaction works. So I think, that said, I think in some cases there will be times where you do want to divest. And probably the best example is actually around some of the oil companies at the moment, because if we look at them, some of them are taking action, they've published net zero plans, others of them, it's like talking to a brick wall. So we have seen a few asset managers divesting from one or two of them who are just not listening and not willing to change. And that's done on the basis of risk, and that actually you don't want to be invested in a company where you've got that risk for the longer term and they're not listening. Sort of moving back onto your point about the consumer and what they think about it. One of the interesting things about pension schemes is obviously you're investing for millions of people. I think there's something like 20 million people in a pension scheme at the moment, courtesy of auto-enrolment. So that's fantastic. But what we tend to find is most people, when you make the investments available, you have to have a default. So that's a strategy that basically looks after someone from when they join to when they retire. And it's basically, if you don't want to make a decision, or you're too scared to make a decision, or you haven't got time, that's where your money would be. And typically, we probably find about 95% of members stay in the default, and there's maybe an adventurous 5% who will go off and choose their own funds and be interested. But the bulk of money is in that default. So when we talk about greening it, it has to happen there. So the pension schemes themselves have to do that. But also, I think there's a lot they can do to communicate to people around that. So there's some quite simple messages, there's some quite easy things you can do. And there was a nice stat, I'm probably going to get the number wrong, but I read in terms of we're all thinking about electric cars or flying less. Actually, if you can green your pension, it can make 22 times more difference to your carbon footprint than all of those other things put together. So it can make a huge difference, and it really shows that that's the way to do it. And it is possible. So if I think about what we're doing, we've just set up something we call a Global Impact Fund, but it's about investing in companies that are investing in solutions. So it could be renewable energy, but also on the social side. But that's something that's, again, it's trying to help members who are invested actually see how their money can put to a different use. And that's something that really, I think, resonates with a lot of people, because people are thinking about it in their day-to-day.
Thank you. I'll go to questions from the floor. So I think we've got a roving mic. So do please put your hands up if you've got a question you'd like to ask. I'll go to the gentleman over here first. And I'll take two in one go. So if anyone else does have one, do please. Yeah, and then the lady here in the middle. Thank you.
It's always very irritating when you start what you're about to say with, this is a question/observation. I know, I apologise in advance. This is for Felicity. I didn't realise you would trade envoy to Norway. That's fantastic. I work in the shipping industry. I'm a shipbroker. I was in Oslo last week, where I do most of my business with Norwegian ship owners and maritime business people. And it always amazes me when I go to Oslo just how savvy the business community are, and the wider population, about green finance and investing where investment needs to be made. And it also amazes me when you look per capita, pro rata, whatever, how much the Norwegian government invests in renewable initiatives. From my perspective, the shipping industry, the amount of money that's being poured into offshore wind vessels, battery-powered ships, it actually, forgive me, puts our government to shame in terms of what we invest in certain sectors. In terms of what, for instance, we've invested as government in maritime, it is, it is shocking compared to what the Norwegians do. And I just wonder, I suppose here's the question bit, what you think we could try, how we could try and take what the Norwegians do in a very successful way from a business point of view, but also that then seeps into the social mindset of Norwegian people who are, probably the greenest people in Europe, how we could take some of that and learn from that and promote it in our own country and within government circles as well.
Thank you. And the lady on the aisle here, please.
Thank you. I had a question for Joe. I completely accept that if you ask pension fund managers if they are interested in the green agenda, they'll all say yes, as anyone will if you stop them in the street. But how much of the money has actually moved into the green agenda? I was looking into this 2 years ago before COVID, and there seemed to be quite a bit of greenwashing, and there was a lot of talk in the city about the green agenda. But when you compared the big funds with the green funds, it was astronomical. I don't know if in the last 2 years people have been sitting in their lockdown houses and started moving the money around, but it really didn't look like it had gone into any kind of green investment. But they all said they liked it on the survey, I'm sure.
Great. I'll let Felicity come back on that, the gentleman's point about Norway first.
Yes, well, first of all, I'm delighted that you've got such good experiences commercially and personally with Norway. I was recently appointed the trade envoy. I'm going there in a few weeks' time for the first time to meet the new government. And there are lots of opportunities between the UK and Norway. In fact, at the moment, 30% of the UK's gas does come from Norway. And last week, we opened a new interconnector between Norway and Blythe and Northumberland, which is the longest interconnector in the world. I would slightly disagree with you in terms of what the UK has done. We are one of the leaders in offshore wind, and we have actually decarbonised at the quickest rate of any G7 country, and I believe actually of any G20 country. And what we have done, and I think this is the huge achievement, is that we have decarbonised while still growing our economy. So since 1990, we have reduced emissions by 44%, while increasing our economy by 78%. But I agree with you that there is more to be done. I'll look into maritime. I personally am not terribly familiar with that, so very happy to look into that. And certainly looking forward to working a lot more with Norway on the environmental agenda. And just one final comment. Norway faces the same challenges as we do in the North Sea. Oil and gas is still the biggest component of the Norwegian economy. So like us, they are managing the transition from oil and gas to renewables and green energy. And in fact, their election was fought on that basis. So there's a lot of work we can do hand in hand.
Thank you. And Joe, if you want to come back on the lady's point.
So it's a really interesting observation, and it was actually something we spoke about when we saw the survey results as well. Because I think to some extent you're right, there will be a little bit of bias in that, and that people who have done lots of things will want to say, yes, we've done lots of things to you. And also if you ask people, not that many people want to say, no, I'm not bothered at all. That said, I think the survey sort of is reflective of then what we're seeing on the ground with clients and what sort of action they're taking. To some extent, it is, as I said, it's a bit like this giant oil tanker, and it takes quite a while to get it started. And for a lot of these trustees, many of them are lay trustees, so they've got other jobs. They're not just working in pensions. So it's not their area of expertise. So actually it takes a little bit of time for them to get up to speed, learn about everything and to put plans in place. That said, we have seen shifts in money on the ground. So as well as people saying, yes, we've got over 50% of our portfolio, whatever the number is, in these responsible investment products, we are also seeing actually that's what clients are wanting, and we're seeing money shift as well. But again, it does take a bit of time. I'll speak first about the defined contribution schemes because that's where I'm most involved. But certainly for those, a lot of the funds they're looking at are in the listed equity space. So a lot of them are passively managed products, and they're trying to perform in line with an index. And then there's kind of tilts or adjustments made. So you might underweight companies that are not very carbon friendly. You might overweight companies that are greener, say. It's whether you can, and a lot of schemes have opted for that as a first step because it's quite easy to do, it's quite cheap. I think the next question actually is, where do they go after that? Because that's sort of the easy bit to do. It's actually then, do they actually then start to invest in some of the sort of green energy projects? So is it renewable energy? Actually, things that will cost a bit more. So those are some of the challenges that trustees on the ground are wrestling with. For defined benefit schemes, a lot of those have the ability to invest in those sort of less liquid, less easily tradable products already. But again, there's probably a smaller amount of capital available because a lot of it's already tied up in things like government bonds because they're on that lower risk path. But it is a really interesting observation in terms of how I think it goes back to that point Felicity made about working on the taxonomy. It's actually how do you classify things, because it's very easy to say, yep, I've gone all green. And actually you might just be in an index fund that's tilting, not doing very much, but then you might have another fund that's doing a lot more. And I think this is where the dangers around greenwashing come in, that it's quite easy to say you're doing a lot, and actually you really want to know what's under the bonnet and how do you compare different things. And that in turn, if we can get that, will really help, I think, build trust in the financial services and help with the consumer in terms of how they make decisions.
So can I give you a perspective on that question just from the asset manager's perspective? Because we used to deal with pension fund, we ran hundreds of funds in this space and managed billions of pounds, but we had to really work hard, quite frankly, to get pension fund assets into our ESG funds. And one of the big, not to sort of disrespect our host, but one of the big hurdles I think we have in the industry is consultants. We found that, by the way, the context is most pension funds in the UK are advised by a large consultant. In my personal experience, the reason it takes a long time is because consultants require at least a 5-year track record. They require a certain number of assets in the fund already, usually, well, certainly hundreds of millions, if not billions. And so until you get to that level, until you've gone over your 5-year mark, you can't really even have the conversation with a pension fund because you can't even get in to see a consultant about this. So it's one of those, we want everybody to be innovative, but not too innovative. And that is frankly, one of the big problems that we have in this country. I think consultants do a great job, by the way. And they do that and they are hesitant for good reason, right? They don't want to advise on a new fund with no assets that looks good, but they want to, to cover their own backs, they want to see that it's a success first. And I have some sympathy with that, but I don't want any consultant to ever say that it's all on the trustees, they're not moving quick enough, or the fund managers aren't doing a good enough job. Let's just be very clear, it is the consultants who are standing in the way of a lot of progress on this. The second part, though, is that in our pension fund industry, a lot of our pension funds are tiny. It's made up of a lot of very small pension funds. And one of the things that this pension minister is trying to do is to try and find ways to consolidate these pension funds so that they have more clout, so that, dare I say, they don't necessarily have to go with a consultant. They can make their own investment decisions, have their own investment teams, go directly and invest with fund managers. But those are the two issues I would give you from my perspective as to why the assets just haven't moved.
Brilliant, thank you, Gareth. Do we have more questions? I'll take the gentleman here and then the lady 3 rows behind. Thank you.
Thanks. Dean Tyler from Bank Trust. I think Gareth made a really important point earlier about making sure that enough funds can operate in the illiquid environment. And I've been in the debt markets for 25 years, and I think there's a complete fallacy over what is liquid and what is not illiquid. And we actually specialise. We're the only UK investment bank that specialises in raising infrastructure financing in emerging markets. So we're at the very frontier edge of everything that we're talking about here. And it is possible. It takes a hell of a lot of work to raise a couple of $100 million to build something in sub-Saharan Africa or Latin America. But again, a lot of our investors are allowed to invest in things that they deem as liquid. And I know as a 25-year veteran that if they were in any way, shape or form asked to liquidate those liquid assets, then they would be very, very obvious that they are not liquid. And so I'd love to hear more from Gareth really about what potentially can be done from the government side from that point of view.
Thank you. And Jack, the lady, if a couple of rows back there. Thank you.
Hi, Jenny Powell from TSB Bank. And my question is more on the consumer consciousness side of things. So TSB, we're really pleased to be working with a fintech partner, Wealthify, to democratise investing. And earlier this year, we launched our first green finance product. And my question is more in that space. Across our sector, one of the key challenges that we're finding is for consumers, the seemingly slow return on investment for making these big investments in their homes with green mortgages, etc. And so I wondered what your thoughts were on what more we could be doing across financial services and government to try and overcome that barrier, be it mental or financial, to help more consumers do what they want to do, what we know that they want to do in supporting the environment.
Thank you. I'll try and ask for brevity with these so we can get through a few more questions. But Gareth, do you want to kick off?
Yeah, I'll take the illiquids really quickly. So you're totally right. It's a massive, missed opportunity, quite frankly, from a return standpoint for pension funds. If you look at any other institutional investor, sovereign wealth funds in particular, their asset allocation has shifted over many years to be focused much more on real assets, whether that's through companies in private equity or in infrastructure in the frontier markets that you're talking about, emerging markets, and they are just taking on more risk, and as a result, their returns are much higher than pension funds. So one of the things that the government are looking at and progressing with, as I understand it, is something called the Long-Term Asset Fund. So this is a LTAF, as it's known, and this is about changing rules essentially to enable pension funds to be able to take on more illiquidity in their portfolios. Again, you make a fantastic point about the different types of pension funds, though, and some require, just by their very nature, require liquidity, and I'm sure you can talk about that much better than I can. Second point on that, one way you could do it is to intermediate the projects and then have issue bonds off that. So I used to do a lot of work with the World Bank and IMF, and they issue infrastructure bonds. I'd like to see our National Infrastructure Bank issue its own bonds. But ultimately, again, I think the consolidation in the pension fund industry will help a lot with this to enable them to have more direct investments and take on more risk.
Yeah. I mean, I'd just add to that. I think the consolidation point will definitely help with bigger schemes being able to do this, but also getting the right vehicles right. So the long-term asset fund, I'm really looking forward to having that available to actually make some of these things come a reality, because at the moment, certainly for defined contribution investors, it's just really difficult to access them. But for my 20-year-old, if they're going to retire at 65, they've got 45 years to go, so they could lock their money up for 25 years. But it's how you manage the fact that if they want to change jobs and take their pension with them, or something else happens, or they want to change funds, how do you make that work for them? And even really boring things like the contribution that comes in every month, how do you get that invested in the market? So it's all these little things that just need working through. But again, looking forward to those developments.
Thank you. Any more questions on the floor? The gentleman here has been very patient.
I think most people here would be aware that we are in a low interest environment, and that is actually distorting investments. And investments are not just done on ethical considerations, although I think that has been a part of it. It's mathematical, adjustments of risks, returns, and so on. That's what they look at. I think on that basis, green investments would not get a look in. So I think the gentleman who suggested over there, what Norway is doing, is basically they have actually locked into the idea of wealth management funds, having a national wealth management. I think it's something that that could be usefully deployed here with the government's involvement, of being able to give returns to people who are looking to get annuities. Could be a combination of wealth management fund, a bank, and so on, and it could solve a lot of problems, because shopping around for green investments is very intensive, and a big this collateralized approach could make huge amount of funds available.
Thank you. Is there anyone else? The gentleman at the front here.
Thank you. Jim Clark, Zurich Insurance. We moved recently $1 billion worth of our life investments over to a new ESG fund, which we're hoping is going to deliver a 30% carbon reduction. I just wanted to ask about reporting standards. We definitely would welcome more reporting so we can understand these investments better. I think we'd all probably agree with that. What do you guys think of TNFD, Task Force on Nature-related financial disclosures? I know they're kind of working on it at the moment, but what do you guys think of it, and do you think all companies should do it?
I'll go to Felicity and then Gareth.
Yes, let me take the question on Norway and the Sovereign Wealth Fund. So just so that everyone is aware of what this is, the Norwegian government decided that a lot of the profits that came from their oil and gas industry would go into a sovereign wealth fund, which is similar to what a number of the Middle Eastern and Asian countries have. You may have heard that the Chinese and Singapore have got big sovereign wealth funds. The Norwegian one is actually the largest in the world. It's 1.4 trillion. They own about 2.5% of all global stock market indices. But they are simply an asset manager. They are not focused on green investments. I'm sure as part of their strategy, they will have a green approach, but that is not their purpose. Their purpose is simply to manage these huge resources. In terms of finding green investments, I actually think that the fact that interest rates are low often makes long-term, more liquid investments actually more attractive rather than less attractive. I've got to say to the gentleman in the front row, I am not the expert on TFND, but coming to it from a very general, holistic perspective, I do think it's probably more difficult to quantify improvements in nature as opposed to emissions. Emissions one can quantify, but nature is much more difficult. But perhaps some of my colleagues can talk more to the details.
Yeah, I'm just conscious we missed out the TSB question as well, which I skirted over. So let me just very quickly answer you and say, I think you're right. I've already alluded to it in my opening remarks, right? We need to do a better job. There's two things in particular that we can do to improve financial literacy and inclusion, I think. One is I would like to see auto-enrollment expanded to 18 to 22-year-olds. So immediately, as soon as you start a job, you see on your pay slip that you're contributing to your pension, and you know what a pension is. And I think that would have a big impact. The second thing is, this has been debated for so many years, but financial inclusion as part of the national curriculum and where that sits, part of mathematics perhaps, or we need to sort of have a proper look at that within the Department for Education, I think, is what I would do. But I know that a lot of banks and financial institutions are already doing things in the voluntary sector, and would love to have TSB come to Grantham to work with some of our schools. On TFND, I am very conscious that we don't have a TF something for every issue, right? I'm doing some work at the moment on modern slavery, and I'd like greater disclosures on modern slavery as part of the Modern Slavery Act. I am very conscious that we don't keep going with different strands of TCFD. Not to say that nature's not important. I think a lot of it is captured actually in a lot of the environmental and green work that investment managers are already doing. So I actually don't think there's a need for that myself. And if I may, just one last point on the Sovereign Wealth Fund. I actually think more appropriate for this country is a development bank modelled on KfW in Germany. We've got the National Infrastructure Bank, which is it's a great first step. As I mentioned in my earlier remarks, I think having that organisation operate more like a development bank, be able to issue its own bonds, and provide that first loss piece in infrastructure projects will be really impactful.
Thank you. Yes, you wanted to come in. Any more questions from the floor? Okay, well, I'll ask some more myself then, if that's the case. I was going to say, I think we're all very conscious, and I'm loath to kind of invoke Extinction Rebellion at this point, but I'm going to say that financial services have been a particular target of the more extreme fringes of the green movement, and I don't think I'm breaking any secrets when I say that there is probably a wider distrust in a lot of the public of financial services. But how do we use that? How do we combat that and show that actually this is a positive thing? I think a lot of it is not just reacting to what campaigners are doing, but actually say, look, we're leading this. We've got a huge scope to lead it. You've talked already, Joe, about that. I'll just ask you on that, and then I'll go to the gentleman over there.
Yes. So in terms of sort of expanding that to members, part of my job is I work with our master trust, so this is one of the consolidation providers that we talk about. But with that, there is a huge opportunity that I see to sort of, I guess we have to be really careful about educating members, because to some extent we're doing a lot of the work for them, but sharing some of the good news with them and helping them see the benefits of their money, because after all, pension is their money. So we want to sort of share examples of how their money's working, the good it's doing, and so they can actually see that. And I think in turn that helps them value their pension, which is often underappreciated, even though it's quite a valuable benefit. People often don't necessarily appreciate the value because they can't get their hands on it right now. But all of that work in terms of communicating some of those examples of how they're invested really help. The other thing is the role that fintech can play in this. So one of the things we've been looking at is there's some solutions to help show people actually what their money's invested in. So I don't know if any of you have gone out and tried to find a list of companies that your pension's invested in. Has anyone got beyond the top 10 holdings? So it's really difficult to get. And there are some actually quite neat sort of fintech solutions that you have to do a bit of plumbing behind the scenes, but as a member you can log on and they'll give you a list of, if you're invested in, say, a global equity fund, you'll get a list of 500 different companies that you're invested in. So you can actually see the amounts. And from a member education, I think that's hugely powerful in terms of helping people see what they're in and actually sometimes addressing some of the concerns they have. So they might say, well, I don't want to invest in oil and gas companies, but actually they see it's only a small amount and they might think, okay, that's okay, I can cope with that, but I do want to know about this other aspect. So I think that's really helpful to building trust, so people get that transparency, but it has to be in a way that's relatable and easy to understand.
The gentleman over there, thank you.
Yeah, it's following from Gareth's points about infrastructure funding. We are trying to secure some funding at the moment for battery storage projects and solar projects in the north of England, and we're talking to the UKIB at the moment. But one of the questions we've asked the potential funders is what they would like to see from the government to stimulate funding into renewable infrastructure. And the answer coming back was a government scheme that underwrites private sector loans. So not actually putting the money themselves, but just to guarantee, to give confidence to the lenders. I just wonder what the panel would think about that.
I'll ask, I'm conscious that Catherine has just been able to join us, which is great, so I'll ask Gareth literally 20 seconds on that, and then I'll pass over to Catherine.
Yeah, I think on loans, I think British Business Bank has a lot of good stuff going on, and I think that's one of the ways which we could look to have the government provide. I don't know if it would be an entire guarantee for these kind of investments, but certainly British Business Bank are already operating, across the UK economy in that way. I would actually like to see the British Business Bank carve out specific purposes. One could be on batteries or green, whatever. But I think British Business Bank is where we need to go for that.
Brilliant, thank you. And we are delighted to be joined by Catherine Howarth, who's the Chief Executive of ShareAction and serves on the Treasury's Asset Management Task Force. Catherine, I'm very conscious of time, but I'm going to give you a few minutes to say what you want, and then I'm going to have very quick closing remarks from the rest of the panellists. But over to you, thank you.
Okay, well, yes, apologies. I'm also conscious of time, goodness me. Look, first of all, I know this is maybe not the biggest gathering in the whole of the conference, but it is the most important conversation in the whole of the conference, I would say. And just so important that the Conservative Environmental Network, which is a totally brilliant organisation, is sort of really leading the charge on this debate and bringing it to the rest of the party and indeed to the government. There's such powerful momentum around this agenda, and a lot of that is thanks to Mark Carney being a fantastic sort of coordinator and mobiliser and bringing financial institutions across the globe together to make quite powerful, significant commitments, which I think really puts the UK absolutely at the centre. Obviously, the COP conference does, but that's just a moment in time, and we're going to move on. And actually, what we really need is our banks, our insurance companies, our pension funds, and our massively important asset management community to grasp the opportunities, to manage the risks, which are quite serious, and I think to work really closely with government on a very bold agenda. And I suppose that one message I would leave in the limited time I have is that we do need a level playing field because, by definition, carbon is a sort of externalized cost, and business has been able to, for many years, operate very profitably whilst polluting. And actually, in order for the companies that are making serious commitments, whether they're in the finance community or in the real economy sectors, manufacturing, airlines or whatever, to kind of really compete with other companies in their sector, we do need to embrace a kind of smart role for regulation. And I know that that's not always a message that's gladly received in Conservative circles, but I actually think for the UK to continue to lead, it needs to grasp that nettle. And this is a community of individuals and groups around this network that can really support an intelligent approach to that, which I do think is necessary for the UK to continue to be a global leader in the space. So that's, I think there's an incredible opportunity for the UK to continue to lead. We're doing it. There is a risk around greenwash, there's no question about that, and that we will have to kind of make sure that companies that have committed things are really held to account in all of our interests, but actually also for financial reasons. But the role of government, the role of public policy making, and the role of this community and the business sector and the finance sector, I just think we do need to kind of be realistic about how far we can go without a clear set of guidelines and rules and a framework. Not micro-regulation, definitely not, of every industry, but the right framework. And Treasury's looking to put it together. And this community in this room and everyone around it, I think, can play a really important role in helping the government to get it right.
Brilliant, thank you. And that was, that was really positive, and I'm very glad you were able to make it here in time to say that. So thank you. That's brilliant. I will just invite, I'm very conscious of time, I will give our remaining three panellists 30 seconds, and maybe you could just use that time to say what's the one ask of government in your roles as members of Parliament, member of the sector. What do we need to see? Felicity Buchan first.
Well, first of all, I just want to say green finance is a huge opportunity for financial services. And I think it's an opportunity that needs to be grasped by the private sector. Yes, government has got a role, but it really has to be driven by the innovation in the City of London. In terms of what government can do, I think that it's very important that we do see this rollout of the green taxonomy so that we do not have greenwashing, and that is in process.
Brilliant. Gareth Davies?
Let me offer an alternative view, which is let the market determine the best way forward. Please don't, to government ministers, please don't try and get involved in trying to define too granularly what green means to you in Whitehall. Let the market determine it. It's growing already very quickly. Asset managers are very capable of determining who's not telling them exactly all the truth or not. The moment you start imposing government in the investment market, it's a recipe for disaster, so please don't do it.
And my ask would be around support to make it easier for schemes, particularly defined contribution schemes, to invest in these long-term opportunities. So, for example, things like the long-term asset fund, but also encouraging a sort of greater shift towards value rather than absolute cost. I think those are all things that will really help and can be aided by government.
Brilliant, thank you. Well, we've just reached time, so thank you all very much for coming. Thank you very much to all 4 of our panellists. We've still got 3 more SEN events coming up today, so please stick around for our event at 2:30 on heat pumps and the end of the gas boiler, and join us here at 6:30 to hear the Environment Secretary, George Eustice, in conversation with Stanley Johnson, not to be missed. And if you haven't signed up as a SEN supporter, then why not? It's free, it gives you priority access to events, monthly competitions, and much more, so please do so by looking at our website, filling out a form over there, or talking to one of the very tired members of the SEN team who are sitting in the audience. But please give the panel a hand, and thank you very much. Thank you.